There's two bills before Congress right now that deal with provisional licensing for loan officers that are going from depositories to non-depositories and crossing state lines. On the surface, this looks like it could be a great bill, and many in the industry support it. However, Bill Kidwell brings up some great insight as to why this might not be a good decision for the mortgage industry and consumers alike. Listen to what Bill has to say because it affects your business as a realtor or a lender. It's a little long-winded, but it's worth your time because, hey, this is what you do for a living. And today's show is brought to you by Loan Tech. If you need help converting your online leads, Loan Tech is here to help you out. All you have to do is click the link down below, or if you're watching us on Facebook, it's right above my slick new hairdo. Hey guys, Brian Stevens here. I have Bill Kidwell. He runs IMAG, which stands for the Impact Mortgage Management Advocacy and Advisory Group, which started out as information for folks that are writing loans right now. It's turned into compliance for your mom and pop shops, for your 2 to 3 man shops who need compliance but don't necessarily have the money to go ahead and run this stuff. Bill does a great job with this. If you fall in this area and need some help with compliance, I would highly encourage you to speak with Bill. So today we're going to be talking about a couple of bills here. Now, this is kind of hair-splitting nitty-gritty stuff, but I urge everybody to stick with us because this is something that affects you as a loan officer directly. I did a show on 2 bills. The first one was HR 2948, and the second one was S 1753, a House and a Senate bill. And what this did was it allowed for temporary licensing for loan officers who want to cross state lines and those who wanted to go from depositories to non-depositories. I came out and supported this bill on my show. The reason I did so was primarily because the Mortgage Bankers Association and other groups said this was a good bill to support. Further, it seemed to make sense to me that allowing a loan officer to go from point A to point B and allow a loan officer from, say, a Wells Fargo to become a loan officer at a regional banking operation made a lot of sense. Now, Bill Kidwell sent me a very long email explaining to me why my position was wrong on this. After reading his email, I've got to tell you, you may disagree with it, but you will understand the logic. And you may find yourself agreeing with it as well. So, Bill, can you set up your position on these 2 bills?
Yeah, I'd be happy to. In fact, the House bill actually got introduced in 2015 as HR 2121 by Steve Stivers at the time. Most of us in the small mortgage shop community generally oppose it or neutral on it because it really is a bill that helps medium-sized and larger-sized non-depositories acquire assets, human resource, without having to wait a period of time for people to get licensed. The problem that I run into, by the way, I think everybody that I know is supportive, has no objection to the state-to-state license transition period. I think that's a good idea. I think it supports the industry. It supports my ability to move from state to state. And we think it's right-thinking kind of legislation, if you need it at all, because we have the uniform state test, and we have the ability to move, shoot, and communicate from small shop to small shop anyway. But it's not bad legislation. But it stops at that point. The problem that I've got with it is that the way the language is written, and it started as 2121 and it conveys to 2948. I'm not quite so sure about how Senate 1753 reads. It was dropped on August 3rd. For those of us mortals out here in the field, we can't see it yet. GPO hasn't published the text. But I'm guessing that Senator Heller wrote something very similar. And I anticipate it's basically the same. The problem is that when you get into 2948, there's a provision in there that says that in order for a depository-based registered loan originator to move under the provision of this bill, they have to have registered as a loan originator during the prior 12 months before they make the move. The problem is that right now, give or take, there's 465,000 registered loan originators that work. They're registered, so therefore they work for a depository. I did a little primary research last year when the second version of this bill came forth, and it was being promoted by several groups, heavily by the MBA as well. I did a little primary research, and I checked with one of the supporters who's a banker in Texas. I won't name specifics,
Sure.
But I went in, and that bank has about 1,200, federally registered loan originators.
Okay.
Only 100 to 200 of them actually have ever done or participated in the mortgage process. The fact of life is that, for the most part, federally registered loan originators came to be because banks didn't want to take the risk that one of their tellers might talk to a customer and say the wrong thing and violate one of the provisions of the SAFE Act. So it was very simple. They already did all the background checks. They did all the necessary work to get their tellers and their staff on board. Why not just go through the non-event of registering? There's no additional training, no additional continuing ed. There's nothing that says they have to know anything about a mortgage. So what we've said for 2 years, and we said it to Mr. Stivers, and we said it to our congressman here in Colorado, if you want to support the Stivers bill, we ask at least to have an amendment to the provision for this 12 months. One, make it 12 months. Don't say just register during 12 months, the preceding 12 months. And secondly, make them sign an affidavit or bring some kind of a document that says their functional job during the period was that of originating mortgages. Without that, what you're doing is you're basically saying, you're devaluing the whole idea of the 20 hours of pre-licensing education, and you're saying, let's cut these people loose, maybe with no experience at all, maybe never touched a mortgage loan application in any fashion, and we're going to give them 4 months to figure it out. I've got an additional problem, because if you look, while it's, I don't even know if it's still published, the fail rate for the NMLS testing approaches the 60 and 70% rate. So you conceivably could have hundreds of thousands of people, not that it would really happen, but you could have a lot of people out there who are coming in, testing the water. They get to play around in it for a few months. Who knows what harm they do to consumers. And they fail the test, and then they go back to work for a bank. No harm, no foul? I don't think so. I think what we've got to do is, if there's a barrier that says me as a state license guy has to pass tests, has to take education before I can do my job, I should have to. There are dozens, if not hundreds, of industries that won't let you play in their playground if you don't meet the basic qualifications. The people who are going to be allowed from the depositories into our arena do not have to demonstrate any proficiency at what they do in any fashion for 4 months, and they can still be talking to consumers. I just don't think it's equitable. I think it's an unbalanced, unlevel playing field, and it shouldn't be supported by people who want to protect consumers, if you believe 20 hours is protected.
Okay, so, all right, so somebody says, all right, Bill, but these mortgage companies, they're not in the business of trying to run their reputation in the ground and bring people on and put them in front of clients if they don't know what they're doing. They still have to do their due process and go through the hiring process, so you're making a mountain out of a molehill. How would you respond to that?
Well, I would say that, mountains and molehills are kind of in the eyes of the beholder. The issue is that we've been told since 2008 that in order to protect consumers, you must have a de minimis amount of education, and you have to have that education tested every year to prove that you're continuing to keep your trade current and that you're doing your job. I don't see the value proposition of allowing up to several 100,000 people access to that market, and I don't see how that's consistent with the idea that the education is protective of consumers. If you want to do away with education, I don't think that's right either. I actually think we should see more education, and make us pass more strict tests. But don't say it's convenient and it's not harmful to let a few people come in who haven't proven that they know what they're doing yet. Now, if you wanted to tell me that the bill said that for the 4-month period, or I think it's 120 days, that for that 120 days they could be tutored, or whatever, but they can do that now. I mean, there's no restriction that they can go to work and learn the trade a little bit while they're taking their tests, while they're taking their education and preparing. At the end of the day, when you look back to 2008, and I'll use Colorado where I'm licensed as the foundation, when we first got our registration process in place, we actually provided for temporary licensing. But that was because the process was taking 6 months to a year because of background checks and everything, and you couldn't get it done. So there were some accommodations. We're not there now. If I want to get a license, I can get that license pretty rapidly in any state, unless I've got a blemish on my record. That will slow things down tremendously. But that should slow things down for these guys as well. So I don't see the need for it. If you look at the statistics, I mean, people are growing. The industry's growing by leaps and bounds right now. People don't seem to be having problems getting their licensing. What do I do if I work? What if I work for a cosmetologist and want to become a mortgage guy? I can't just jump ship and come over.
So you're saying of the 465,000 people that you're speaking of, the vast majority of them don't know anything about writing loans, and I will concede that point. If you're a teller, it doesn't give you any knowledge whatsoever, just like a cosmetologist, on how to write a loan. So your issue is with the vast majority of people who would get this temporary license and be able to go out there and write loans. In short, you're saying don't let somebody drive the 24-hour Le Mans with a driver's permit. I mean, that type of thing.
That's a great analogy. I would simply say, look, if the criteria under which we've operated for almost a decade now is legitimate criteria, if everybody has to go through getting that before they can hang their shingle on their door, then just because I was allowed to register as a federal loan originator with no functional requirement to perform as an originator, I don't think they should be allowed. And in my perspective, just give me an affidavit that says you were doing the work of an originator, and I mean, I'd back off a little bit.
Isn't it interesting to see how quickly our legislators will throw previous regulation just down the tubes if they have a need to fill? And right now what's happening is they have a need to fill. They're saying we need more originators, we need more competition, we need more loans written. Therefore, all the regulation that we wrote over the past 8-9 years to shore up the industry, we're just going to throw that out the window. And that's effectively what's taking place.
Well, what's interesting to me is if you look at the NMLS statistics, and let's look at 1Q 2017, which they published, because I think it goes to the essence of that justification. You need more originators. Right now, if you're looking at the state license group, there's about 135,000 individual people doing origination that aren't in the depositories. Only 70,000 of them are considered active. And active, by the definition of the NMLS, is one loan per quarter. So tell me, where's the excess demand that requires us to reach into the banks looking for people that may have no skill set, may have no experience, they've got a title that says registered loan originator, and we want to cut them loose on consumers. When we have a Federal Reserve Board, every consumer law firm in the country who said you got to be educated, you got to get this done. I mean, your analogy of a race driver on a learner's permit is a great one. We don't need to do it, so why would we support it? This is unnecessary legislation as written. We don't need it to support state transition. It'd be nice. I've got no objection to it, but we don't need it. We definitely don't want it to support the ability for an untrained individual to simply jump into the pool in the deep end, working directly with consumers. I just think it's bad legislation.
Well, it does seem to contradict post-crash LO regulation that's been put in place.
I'd agree with you.
So now, but what you are telling me is if you had a loan officer who was working at, say, a Wells Fargo who needed a transitional license to get his 20 hours of education in, you would be okay with, you would back off on that point. Your issue is with all the other people who have a license who are not working in the capacity as a loan officer. Is that correct?
Yeah, in fact, I've communicated with Mr. Stiver's office as well as to my congressman, if you could just throw that amendment in. I mean, I've got the document from 2015 when the whole discussion started. I said, look, we would acquiesce to that. Just make them sign an affidavit. I mean, if we trust them enough to come in and do business with our consumers, trust them with an affidavit. Make them give a sworn statement that's what their job has been for the last 12 months.
Well, and for the other loan officers out there who had to go through the rigors of the education, it seems a little bit unfair to them. You know,
I agree. It's an acquiescing point. I mean, it's not that I support it. I wouldn't oppose it vehemently if that's what they had to do. But I believe the bill on its surface, both 1753 and 2948, are unnecessary bills. We've got more important things in our industry that my constituents and my guys ought to argue about, and that's bills like the Huizenga bill that doesn't protect us from the 3% double count on lender paid comp.
Right.
I mean, there's a whole segment of this industry that's disserved, and its consumers are disserved.
Absolutely. I agree with you on that.
Because of this double count of an item that's already in the total cost for the consumer. And I mean, I would rather see our time spent supporting the Posey bill that's been reintroduced and supporting an amendment to the subset of H.R. 10 that's conveying bad legislation from Mr. Huizenga's bill. I'd rather see that changed.
With regards to 2948 and 1753, what type of support does it have? And are you getting support? Is there any type of grassroots movement that is that's got a voice that could possibly change either one of these?
Well, I think the problem is, as you know quite well, this is trying to herd cats. And I mean, I'd like to think that IMAG, I mean, we've got several thousand people that are registered users. I'd like to think that my guys could create a voice. I personally have escalated it to my membership, to my congressional membership. And I know that we have leadership in our local association who opposes the bill just as I've expressed. Whether or not, I mean, part of the problem is that our national association seems to be aligned with the bill. And in that regard, my problem is that this bill does serve some people. I mean, there are maybe 200 or 300 shops out of the 16,300 that are out there that have 50 or more LOs that probably would like to have this because it gives them some recruiting capability and the like, and they figure they can manage it. I don't know how you get a grassroots groundswell of support that would be heard.
Well,
I mean,
we might be doing it right now.
Well, I mean, I'm going to reach out to my guys and have them go to their congressman and oppose it. And that'll reach a couple of thousand guys who I think share my perspective. But, you know, I mean, when you get a trickle of 2 or 3 going into, I mean, let's face it, 2948 has 18 co-sponsors, 12 of them Democrats. So everybody's saying bipartisan, what can be wrong with it? You know, it doesn't matter if everybody's wrong. You know, that doesn't make it better. So, you know, I mean, we will be reaching out to folks and saying, look, we don't think it should be moving forward. But whether or not we'll succeed is yet to be determined.
Bill, thank you so much for your time. And by the way, one last time, Bill Kidwell with the Impact Mortgage Management Advocacy and Advisory Group. If you are a 2, 3, 4-man shop and you need help with your compliance, I can attest firsthand that Bill is fantastic at this. As you can tell, he's bright beyond words. And his price point, this is most important, his price point is something that's not going to break the bank. If you're looking for help in this area, I strongly urge you to contact Bill Kidwell, and his contact information is right down below or right up above.
Thanks a lot, Brad. Thanks for inviting me and giving me a chance to say something about this.
You bet. Thank you so much.
Take care. Bye-bye.